Let's take a look at the bigger picture. Matthew Johnson's with us, president owner, Johnson Wealth and Income Management. Thanks for being here. Are people, is the wool over our eyes because we're going to have another winning week on Wall Street?
Well, it could be. You know, we're an optimistic lot, and I like seeing the numbers. I know that it's super exciting when we see that, gosh, you know, the S&P 500 is up 5%, the NASDAQ is up by almost 10%. That's super optimistic news, and it feels good, it looks good. But the reality is, I think we have to temper our expectations because we know that the Federal Reserve is going to be announcing in February that they're probably going to do another rate increase. And that's because they cannot lose sight of the inflation and the job that they have at hand. We have to hand it to the feds. I have the highest degree of respect for them. They have done what I consider to be a really difficult job. And it looks as though they really are trying to bring things down very slowly so that they can, you know, as it were, have the soft landing. But we have to be able to expect that when we wake up in the morning and we see that the feds are still on track raising interest rates, that is probably going to create some sort of volatility in the market. And we've got to be prepared to maybe give up some of those gains that we've seen since the first of the year.
Yeah, I mean, the Fed, you think they're still going to be working to tame inflation, right? I mean, you're seeing 25 and 25. Is that what you're likely guessing?
No, I'm not. I'm actually more optimistic that there's probably going to be a 50 basis hike before they actually, and they might even do two, but I think that we can expect at least one more 50 basis point hike. Wow. Before they switch over to the 25. Now, I hope I'm wrong, because if you look at how things have progressed, you know, they went 25, they went 50, and then 75, 75, 75. So they might only do 150 basis point and get back down to 25. But I think we have to be pretty careful. I think that they got one more left in their system at 0.5%.
Yeah, and if they do that, then the market sells off. Is that your point?
Well, I believe that it's going to soften quite a little because we're going to wake up and we're going to go, oops, that's right. They're still doing what they're doing to contract the economy. And you know, what they've been doing is working. And I think that at this point in the cycle, they actually have some momentum. But we're seeing a lot of layoffs, right? We're seeing the job market contract. We're seeing profitability coming down for many different corporations. And of course, as that continues to plug along, it can start to feel like death by 1,000 paper cuts, let's put it that way. And so as a result, you're looking at the stocks that you own, you're looking at the profitability, and you're saying, maybe I should use this as an opportunity to maybe, if I'm up 5 or 10%, maybe trim some of those so that I don't give away everything that I just got done making since the beginning of the year.
Yeah, understood. So at this point now, how do you lay the groundwork for investing and making some money?
Well, we've discussed this before. I think it's super important with what's going on economically that we're very, very careful to observe the numbers. We can't just look at a stock price and go, oh, well, you know, it's affordable, I can buy that one. We have to go down into the fundamentals, and we have to look at PE ratios. We have to look at the profitability. Do they have cash? Are they paying a dividend? Are they free cash flowing? Do they have too much inventory? If I'm looking at a corporation and it's got way too much inventory, I'm probably going to pass by that one. If you have a shorter time frame, then we've got to be able to really focus on the companies that are going to pay a dividend. And I would say continue the dollar cost averaging, but you cannot give up the fixed income sector. I cannot emphasize enough. When you're looking at the prices, you know, I'm a fixed income guy. One of my greatest fears is that the bond market really starts pushing back hard, kind of like they did in 2018. I'm continuing to be hopeful that there's going to be another rate increase because I love buying my fixed income securities for my clients at a discount. When you're seeing bonds pay 5.5% and you're seeing preferreds at 6% and 6.5%, and even business development companies pushing the 7% and 8% yield mark, man, that's real. That is profitable for a person. And we know that when the feds begin to finally halt these interest rates and they start to, at some point, lower them to get the economic car back on track again, I know that we're going to see some wonderful recovery in the price of these bonds. So if we can use the math and the wisdom of the math to kind of guide us, we're able to position ourselves to buy at a discount and then be able to watch the exponential growth and the increase in the value of those fixed income instruments. So you can't ignore it. It's good diversification, and it's real income, and interest and dividends really help us to compound our returns over time.
Yeah, I mean, you love the dividend payers. I see why, and you mentioned dollar cost averaging and getting in a little bit at a time, without a doubt. When you think of things like technology, for example, that have been beaten down in such a big way, do you start to say, hey, I mean, you can't resist, I got to get some, or no, do you stay away?
Well, I heard a report this morning that was talking about how the cellular phone business, there's statistics out there that would suggest that people are holding on to their phones longer, like up to 3 years before they would trade in. In some respects, part of me says that we've really we've feasted on the technology that we wanted and that we needed, and so we're taking a bit of a respite now. I'm sure that the technology companies, with all of the sell-offs, are going to see some greater profitability as a result of that. Obviously, that's tremendous overhead, and if they overhired and they have somewhat thin profits that are coming in, doing what they did, even though it's super painful and no one likes to see it happen, it is going to positively affect the bottom line. So I'm not going to throw the baby out with the bathwater. I think technology still very much has a place here. I just think that we may see growth, but it's going to be tempered and it's going to be quite a bit slower, and we've got to be able to give it some time frame to build that momentum back.
And the 50 basis points, that's a big call, Matthew Johnson. I wrote it down, I'm taking note. If they come out with 50, I'm going to say Matthew Johnson was the one who really pushed for that. I mean, pretty amazing. I'll watch for that. Matthew Johnson, Johnson Wealth and Income Management. Nice to see you. Thank you.
Thank you.